Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The Fed cut its benchmark interest rate today by 1/4 point, and policymakers in aggregate also penciled in 2 more 1/4 point cuts this year. Now, the Fed statement points to growing signs of weakness in the labor market as a justification. Here is Fed Chair Jay Powell.
You could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
At the same time, Powell reiterated the danger of tariff hikes in creating a persistent uplift in inflationary pressure. By the way, this vote was 11-1, with newly installed Fed Governor Stephen Miron pushing for a larger half-point reduction. In a moment or two, we'll get the market views of Stephanie Leung. She is the Chief Investment Officer at Stashaway in Hong Kong. But we begin here in the States. Joining me now is George Schultze. He is founder, CEO at Schultze Asset Management. Thanks for making time to chat with me about this, George. A lot going on in markets. Let's begin with the Fed. Not really a big surprise, right?
No, not a big surprise, although some people were perhaps a little too optimistic and expecting a 50 basis point cut. But the market certainly expected action today, and it got pretty much what the expectation was at 25 basis points.
So I was struck by the fact that here is Powell kind of reinforcing the idea that maybe tariffs begin to filter into persistent inflation. Is that a worry that you share?
So not really. I'm a little bit more of the camp that the tariffs are helping our economy and, hopefully bringing some, capital back from overseas. But clearly there was a lot of concern that tariffs would cause more inflation. And, it's really not, as much of a problem here as labor market seems to be at this point. So, it's a tough time for the Fed, but I think they made the right decision here.
So help me understand then, from your point of view, while we saw a bit of a backup in yields right across the curve, I think in the case of both the 2 and the 10, up a little bit more than 5 basis points in each case.
Right. Yeah, and if you looked at it yesterday, anyway, the yield curve continues to be a little inverted. So it's a good thing that they lowered the short-term interest rate a little bit more. I think that really helps banks, and I think it helps the overall picture. It takes away some of the risk in the in the early part of the curve in terms of expecting potential future recession or stagflation. So this move, I think, is preemptive, and it helps address that risk. And really helps, I think, banks that make money on the spread going forward.
So Stephen Miron dissented in today's vote. He was pushing for a half-point rate cut. One of the things that Miron has done in being installed recently as a Fed governor has created a lot of conversation around the idea of Fed independence. Is that something that you're concerned about? Does the Fed need to do more to demonstrate that it is independent from the executive branch?
I don't think so. I think the Fed has really walked that line well, and all the controversy with Cook and attempts to change things along the way, and the reaction that the Fed has really shown its independence and shown how it navigates the choppy waters when times change like they have recently. I think going forward, the big change that we should all expect, of course, is that Powell next year, his term will be up, and at that point, it appears more likely that the next leader will be more on the lower rates camp. But clearly, there's been a lot of pressure between the Trump administration and the Fed and independence, but I think this meeting specifically proves its independence, and despite the fact that its building project was audited and reviewed, and there was a lot of press and focus on it, and then the whole thing with Fed Governor Cook, made a lot of headlines, but still the Fed acted very independently, I think, here.
So the Fed's decision and the Powell press conference kind of failed to rattle the equity market beyond maybe a minor blip. There was a little bit of volatility, but the range of trading today was, I would say, fairly narrow. Are you constructive on the equity market going forward?
We are here at Schultze Asset Management, but really, the key is here, Doug, finding companies that are cheap and not just throwing money at the big names or the Mag 7, for instance. So we're constructive. There are some companies that are particularly inexpensive, and some of them have really interesting events that are likely to drive them higher. One of them is a regional bank, Flagstar, which should benefit from these lower rates here. Its spread business of generating net interest income will clearly increase now with short-term rates having dropped a little bit. But yeah, we're generally constructive on the equity markets, and I think that this was the right move that the Fed made.
Saw the Russell 2000 getting a bit of a lift today. Would you tend to say that the current environment right now, with declining yields, lower rates, that tends to favor some of the small cap, mid cap space?
I do think that's right. But you still have a couple other risks in the market. You have higher inflation that's been sticking around. You have interest rates, even though they've dropped a little bit today and are likely to drop 2 more times at least this year, it looks like, based on market expectations right now. Either way, they're still much higher than they were just a couple of years ago, where we had zero interest rate policy. So that's a big change for companies that are over-levered. And you also have secular change, and that includes technological change such as AI. And so those big overhang risks can really impact companies that are over-levered. But for smaller companies, sure, lower interest rates should help them, and I think possibly ignite some animal spirits in their stocks.
How do you assess the risk of stagflation right now?
Well, I think that's one of the things that the Fed was concerned about. Having a softening labor market, along with inflationary pressures continuing to come through, and that's exactly what you've been seeing. So that's I think that's one of the main reasons they lowered the rate today. And you've seen that because some companies are forcing higher costs through from tariffs to their customers. You're seeing that with food, appliances, automobiles, and even the Bank of International Settlements recently suggested that some of this might be complicating the Fed's dual mandate and creating that kind of risk.
Right now, President Trump is in the UK. We heard from him earlier touting some of the high-tech deals that were going to be or will be announced tomorrow, with names like Microsoft and OpenAI being involved. When you look at the big tech story right now globally, whether we're talking about South Korea, whether we're talking about Hong Kong and by extension China, whether we're talking about the UK even, and obviously here in the States, how are you feeling about big tech in the current environment?
I think these big tech companies, they're positioned pretty well, and they certainly have Trump's ear. He's getting deals to the table for him or for them. The TikTok announcement from yesterday was big news, and there are some big U.S. investors that look like they'll benefit from that. But clearly, part of negotiating tariff deals includes helping some of the largest companies in the U.S. And I think some of these big companies will really benefit from that as you keep seeing tariff deals get made going forward. Having said all that, some of them have really appreciated to unbelievable levels, and really makes me wonder whether there's still a lot more upside in their valuations. So we're trying to pick our winners and future gainers in different places for now.
So you're rotating a little bit? I mean, taking money off the table in certain names and redeploying that cash in other areas of the equity market? Is that what I hear you saying?
A little bit, yeah. I mean, we didn't have big exposure to the Mag 7, for instance, to begin with, but we certainly think there are some great opportunities with event-driven stocks, companies that are fundamentally cheap on a valuation basis, and specifically those that happen to have an overhang of distress that has put a cloud over them from distress or situations that they were enveloped with in the past.
George, we'll leave it there. Thank you so much. George Schultze, he is founder and CEO of Schultze Asset Management, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Chinese-focused ETFs rose in the Wednesday session and provided a modest tailwind for Asian peers. Let's take a look at markets across the Asia-Pacific more broadly now. Joining me is Stephanie Leung. She is the Chief Investment Officer at Stashaway. Stephanie joins us from our studios in Hong Kong. Thank you so much for making time to chat with me. If you don't mind, I'd like to begin the conversation around this rally that we have seen, a powerful one at that, in markets like Hong Kong and South Korea. What do you think is driving this?
Yeah, I think if you look at kind of emerging markets as a whole, it's been actually rallying quite a bit in recent months. So the restart of a interest rate cycle, cut cycle, is actually typically quite good for emerging markets, particularly given that US dollar now is actually quite reasonably priced compared to, let's say, a year ago. So a kind of weaker US dollar environment coupled with further interest rate cuts from the Fed typically creates a fairly good environment for emerging markets. Now, if we look at kind of the fundamental data, of course, like China is still kind of the elephant in the room, but even China, seems to be slowly turning around a corner. Recent data suggests that the Chinese economy is sort of stabilizing. There are some pockets which are picking up, but of course, it's a big economy, so it'll take some time to turn around. If you look at some of the other Asian markets, Japan market has been kind of boosted by a return to inflation. And of course, if you look at kind of the more tech-heavy markets like Korea and Taiwan, those have been boosted by the investments in AI. So I think there are various stories going around in emerging markets, which supports kind of investor coming back to relook at what are the opportunities there.
Do you have a sense of the balance between institutional participation right now and what may be happening from the retail crowd? How is this balanced, do you think?
So I think it depends on the market, obviously. I think and also from kind of what investor base, right? Are we talking about international investor base or domestic? So I think from a international kind of investor-based perspective, most of the flow is still kind of institutional. I think it's a lot of that is sort of rebalancing out of the U.S., partly triggered by the sort of the trade tariff scares in the beginning of the year, right? And also a kind of a relook at the overweight in U.S. So I think that's sort of the flow that we've been mostly seeing from a international investor base. From a domestic side, I think there are some signs that the animal spirits are returning a bit to the market. So take, for example, in the Hong Kong market, which is kind of closest to our heart, the IPO market has been actually quite hot. And typically when you see kind of hot IPO markets, that's a sign that retail is coming back. Even if you look at China onshore, right, Asia market is typically not an internationally driven market. That has been on a tear, and significant part of that is because of the excitement around technology, around kind of some of the themes that China is pushing through. So again, I think from a domestic perspective, there is increasing kind of retail participation, but I think from an international kind of asset allocation point of view, most of it is still institutional. Even within our platform at Stashaway, we don't see most of our investors are actually kind of retail investors. Of course, that includes a lot of the kind of more premium retail investors, but still, what we're seeing is still not a lot of kind of euphoria or love for emerging markets yet.
So you mentioned technology. Now we know since the DeepSeek moment that has certainly been a big driver for equity markets in the APAC region. But I'm wondering about betting on the strength of the consumer right now across the Asia Pacific. Is that becoming a trend that you think is durable? Whether you're looking at e-commerce names like an Alibaba or a Baidu or even a Yum China, whether people are betting on a return of consumer strength?
I think it's actually been quite selective, I would say. Because if you look at China, for example, the economy is still stabilizing, but it's not coming back in a vengeance, right? It's not very, very strong recovery. So I think if you look at kind of pockets of consumer names, there are names like Pop Mart or some of these like Chinese IP names that have been on a tear. And I mean, that shows strength in terms of, I think not just kind of the strength of the Chinese consumer, but more of the strength of some of these newer Chinese brands, which are actually going international. So, I mean, Pop Mart is, of course, the maker of Labubu, which has been kind of a phenomenon in the last kind of 12 to 18 months. And apart from that, I think if you look at some of these Chinese e-commerce names, they are much more affected by what's happening domestically, right? And onshore, domestically, they are, in fact, I mean, fighting a price war, right? The likes of Meituan, like JD, even Alibaba are involved in heavily subsidizing the consumer in order to grab market share. And that's where I guess the companies are still in a heavy investment phase. And I mean, those areas are, of course, not so great for equity investors. So I think it really depends on what segments and what kind of sub themes we're looking at, instead of like a broad stroke saying, these companies are all going to benefit from the Chinese consumption story.
I'm wondering about, for as much experience as you have in markets, whether you've seen in the past big moves like this that have happened over a short period of time, and whether that has created in your mind a great deal of concern, and as a result you may be beginning to put in some hedging strategies in place.
I think if you look at like the U.S. market, for example, it is, of course, like pretty expensive on a valuation basis. But I think that's sort of also quite heavily skewed towards the big caps. And just, I mean, perhaps the tech sector. If you look at kind of outside of the tech sector, for example, in the more cyclical part of the market, and also into like even mid caps or smaller caps, those are relatively actually quite cheap still. So I think it's, I wouldn't say it's sort of like a bubble right now, in the sense that, the risk of a kind of 30% plus drawdown is significant. Because of two things. Number one, as I mentioned, I mean, valuation kind of premium is much more focused on in the big caps. And secondly, I think if you look at the fundamentals of the U.S. economy, yes, there has been some slowdown in the labor market. But I think if you look at things like liquidity, if you look at things like credit spreads, or even if you look at some real-time kind of consumer data, those are still going very, very strong. So I think in the next kind of 6 to 12 months, the risk of a recession is pretty low. So I think that from that angle, I don't see a significant risk of a big drawdown. So I think, yes, I mean, could we see like a 5 to 10% correction? Yeah, absolutely. I mean, these are things that happen like every few months. But anything much more sinister than that, I think that's fairly unlikely for now.
I'm wondering about whether you feel that way about equity markets in the Asia Pacific, where we could see a bit of an interruption maybe and a move lower.
I mean, of course, like Asia Pacific markets, like sort of tends to be more volatile than the U.S. market. So from a beta adjusted perspective, yes, I mean, there could be kind of, if the U.S. corrects 10%, I mean, Asia Pacific markets could correct kind of 10 to 15%, right? But I also think that there's a cushion in terms of valuation and also a cushion in terms of investor positioning. So I mentioned that there has been a kind of rotation trade out of the U.S. into Asia Pacific or emerging markets from an institutional level. I don't think that's happening on a retail level yet. So from a kind of positioning perspective, I think there's still room for investors, particularly international investors, to add to emerging markets. And I think that's starting to happen, particularly with the easier kind of liquidity environment. So I think the risk of that correction is I guess is not that high in my view.
Okay, we'll leave it there. Stephanie, it's always a pleasure. Thank you so very much. Stephanie Leung there, Chief Investment Officer at Stashaway, joining from Hong Kong here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.